The ETF landscape from 2020 to 2025 has been dominated by extraordinary performances that few could have predicted at the start of the decade. The results reveal fascinating trends about European banking sector dominance, the power of leveraged instruments, and the surprising underperformance of traditional US market favorites during this specific period. All returns are calculated in euros to ensure consistency across the dataset, though this may introduce currency effects for ETFs denominated in other currencies. The 5-year period spans from August 2020 to August 2025, capturing the full impact of the post-pandemic recovery, the inflation surge of 2021 to 2022, and the subsequent market dynamics through mid-2025. Here are the definitive top 10 rankings, counting down from 10 to 1. Number 10. Amundi MSCI Semiconductors ETF. 238% 5-year return. Taking the 10th position is the Amundi MSCI Semiconductors ETF, delivering a remarkable 238% return over 5 years. This fund provides exposure to the global semiconductor industry, which experienced unprecedented demand during the digital transformation accelerated by the pandemic. The semiconductor sector benefited from multiple tailwinds including artificial intelligence development, electric vehicle adoption, and the ongoing digitalization of the global economy. The ETF tracks companies involved in the design, manufacture, and sale of semiconductors, including industry giants like NVIDIA, Taiwan Semiconductor Manufacturing Company, TSMC, and Advanced Micro Devices, AMD. With a reasonable expense ratio of 0.35% and a fund size of €55 million, this ETF captured the explosive growth in chip demand that characterized the early 2020s. The semiconductor industry's performance during this period was driven by several key factors: the work-from-home revolution that increased demand for personal computers and networking equipment, the rapid adoption of cloud computing services, the emergence of artificial intelligence as a mainstream technology, and the global shift toward electric vehicles which require significantly more semiconductors than traditional vehicles. Number 9. Amundi MSCI Greece ETF. 264% 5-year return. The 9th position belongs to the Amundi MSCI Greece ETF, which delivered an impressive 264% return. This fund's exceptional performance reflects Greece's remarkable economic recovery following the sovereign debt crisis of the previous decade. The Greek economy benefited from European Union recovery funds, a resurgent tourism industry post-pandemic, and significant structural reforms that improved the country's business environment. With a fund size of €222 million and an expense ratio of 0.45%, this ETF provided investors with exposure to Greek equities during a period of substantial economic revitalization. The fund's performance was particularly strong in 2025, gaining 55% year-to-date, indicating continued momentum in the Greek market. Greece's banking sector, which had been severely impacted by the debt crisis, underwent significant consolidation and recapitalization during this period. Major Greek banks like National Bank of Greece and Alpha Bank emerged stronger and more profitable, contributing significantly to the overall market performance. Additionally, Greece's strategic position in the Eastern Mediterranean and its role in European energy security discussions added to investor interest in Greek assets. Number 8. Amundi Stocks Europe 600 Banks ETF. 315% 5-year return. The 8th position is occupied by another banking sector ETF, the Amundi Stocks Europe 600 Banks ETF, with a 315% return. This fund provides broader exposure to European banking stocks compared to the more concentrated Eurozone banking ETFs that rank higher on our list. With €1.636 billion in assets under management and a 0.3% expense ratio, this ETF captured the remarkable recovery of European banks following the pandemic-induced lows of 2020. European banks benefited tremendously from the rising interest rate environment that began in 2022. As central banks across Europe raised rates to combat inflation, net interest margins expanded significantly, boosting bank profitability. The European Central Bank's shift from negative interest rates to positive territory was particularly beneficial for the banking sector, which had struggled with compressed margins for years. The fund's performance was also supported by improved credit quality as European economies recovered from the pandemic, reduced loan loss provisions, and increased lending activity. Major holdings likely included banks such as ASML, Banco Santander, BNP Paribas, and Deutsche Bank, all of which experienced substantial appreciation during this period. Number 7. Invesco European Bank Sector ETF. 318% 5-year return. Claiming the seventh spot is the Invesco European Bank Sector ETF with a 318% return. This specialized banking sector fund, with €360 million in assets and an ultra-low 0.2% expense ratio, provided focused exposure to European financial institutions during their remarkable recovery period. The fund's exceptional performance reflects the perfect storm of favorable conditions for European banks: rising interest rates that expanded net interest margins, economic recovery that reduced credit losses, regulatory clarity that allowed for increased dividend payments and share buybacks, and improved operational efficiency following years of cost-cutting measures. European banks also benefited from increased merger and acquisition activity within the sector, as stronger institutions acquired weaker competitors, leading to improved market concentration and pricing power. The fund's 2025 performance of 56% year-to-date suggests that the banking sector's outperformance continued well into the final year of our analysis period. Number 6. iShares Stocks Europe 600 Banks ETF. 319% 5-year return. The sixth position belongs to the iShares Stocks Europe 600 Banks ETF, delivering a 319% return. This fund, with an impressive €2.754 billion in assets under management and a 0.47% expense ratio, represents one of the largest and most liquid ways to gain exposure to European banking stocks. The fund's performance mirrors the broader European banking recovery story but benefits from the scale and liquidity that comes with being one of the largest ETFs in this sector. The iShares brand's reputation and the fund's substantial size likely contributed to consistent inflows throughout the period, providing additional support for performance. The European banking sector's transformation during 2020 to 2025 was remarkable. Banks that had struggled with low profitability and regulatory uncertainty emerged as some of the strongest performers in global equity markets. The sector benefited from a combination of cyclical factors: rising rates, economic recovery, and structural improvements, digital transformation, cost reduction, improved risk management. Number 5. Amundi IBEX 35 Doble Apalancado Diario, 2X, ETF. 355% 5-year return. Taking the fifth position is the Amundi IBEX 35 Leveraged ETF, which delivered a spectacular 355% return. This fund provides 2x daily leveraged exposure to the Spanish IBEX 35 index, amplifying both gains and losses of the underlying Spanish equity market. Spain's equity market experienced a remarkable recovery during this period, driven by several factors: the country's successful management of the post-pandemic economic recovery, significant European Union Recovery Fund investments in infrastructure and green energy projects, a robust tourism sector rebound, and strong performance from Spanish multinational corporations. The 2x leverage magnified the IBEX 35's strong performance, but investors should note that leveraged ETFs are designed for short-term trading rather than long-term holding due to the effects of daily rebalancing and volatility decay. However, in a sustained bull market like Spain experienced during much of this period, the leverage worked in investors' favor. With a fund size of €43 million and a 0.4% expense ratio, this ETF provided sophisticated investors with a way to amplify their exposure to Spanish equities. The fund's 70% gain in 2025 alone demonstrates the continued strength of the Spanish market. Number 4. Invesco Euro Stocks Optimized Banks ETF. 360% 5-year return. The fourth position is claimed by the Invesco Euro Stocks Optimized Banks ETF, with an outstanding 360% return. This fund, managing €189 million with a competitive 0.3% expense ratio, focuses specifically on Eurozone banking stocks, providing more concentrated exposure than broader European banking funds. The optimized approach of this ETF likely contributed to its superior performance compared to market cap-weighted alternatives. The fund's methodology may have resulted in better exposure to the strongest performing banks within the Eurozone, avoiding some of the weaker performers that might have dragged down broader market cap-weighted indices. Eurozone banks faced unique challenges and opportunities during this period. The European Central Bank's monetary policy normalization was particularly beneficial for these institutions, as they had been among the most negatively impacted by the previous era of negative interest rates. The fund's strong performance in 2025, with a 67% gain, suggests that Eurozone banks continue to benefit from favorable operating conditions. Number 3. Amundi FTSE MIB Daily Leveraged ETF. 366% 5-year return. Securing the third position is the Amundi FTSE MIB Leveraged ETF, delivering an impressive 366% return. This fund provides 2x daily leveraged exposure to the Italian FTSE MIB index, capturing and amplifying the remarkable performance of Italian equities during this period. Italy's equity market experienced a dramatic transformation from 2020 to 2025. The country benefited enormously from European Union recovery funds, with Italy being the largest recipient of the Next Generation EU program. These funds supported massive infrastructure investments, digital transformation initiatives, and green energy projects that boosted economic growth and corporate profitability. The Italian banking sector, which had been a source of concern for European regulators for years, underwent significant consolidation and strengthening. Major Italian banks improved their capital positions, reduced non-performing loans, and benefited from the same rising interest rate environment that helped banks across Europe. With €102 million in assets and a 0.6% expense ratio, this leveraged ETF amplified the FTSE MIB's strong performance. The fund's 55% gain in 2025 demonstrates the continued momentum in Italian markets. However, as with all leveraged products, this ETF carried significantly higher risk and volatility than unleveraged alternatives. Number 2. iShares Euro Stoxx Banks 30 to 15 ETF. 369.46% 5-year return. The second position belongs to the iShares Euro Stoxx Banks 30 to 15 ETF, with an exceptional 369.46% return. This fund, managing €1.455 billion with a 0.52% expense ratio, provided investors with exposure to the largest and most liquid banking stocks in the Eurozone. The 30 to 15 methodology refers to the index construction that selects the 30 largest banks by market capitalization, with a maximum weight of 15% for any single stock. This approach provided diversification while maintaining focus on the largest, most established banking institutions in the Eurozone. The fund's outstanding performance reflects the remarkable turnaround story of Eurozone banks. These institutions, which had struggled with profitability challenges, regulatory uncertainty, and economic headwinds for years, emerged as some of the strongest performers in global equity markets during 2020 to 2025. Key factors driving this performance included the normalization of European Central Bank monetary policy, improved economic conditions across the Eurozone, successful completion of regulatory stress tests, increased capital returns to shareholders through dividends and buybacks, and operational efficiency improvements following years of restructuring. Number 1. Amundi Euro Stoxx Banks ETF. 379% 5-year return. Taking the top position with an extraordinary 379% return is the Amundi Euro Stoxx Banks ETF. This fund, with €2.711 billion in assets under management and a competitive 0.3% expense ratio, represents the ultimate winner of the 2020 to 2025 period. This accumulating version of the Euro Stoxx Banks ETF automatically reinvests all dividends, maximizing the compounding effect over the 5-year period. The fund's exceptional performance represents one of the most remarkable sector rotation stories in recent ETF history, as European banks transformed from laggards to leaders. The fund's success story is built on several pillars. First, the European Central Bank's monetary policy normalization provided a massive tailwind for bank profitability. After years of negative interest rates that compressed net interest margins, the shift to positive rates allowed banks to expand their margins significantly. Second, the post-pandemic economic recovery reduced credit losses and loan loss provisions, directly boosting bank earnings. Third, years of cost-cutting and digital transformation initiatives improved operational efficiency across the sector. Fourth, regulatory clarity and successful stress tests allowed banks to increase capital returns to shareholders. The fund's remarkable 69% gain in 2025 alone demonstrates that the European banking sector's outperformance continued throughout our analysis period. This performance represents a complete reversal of fortune for a sector that had been among the worst performers in European equity markets for much of the previous decade. The most striking finding from our analysis is the complete dominance of European banking sector ETFs in the top 10 rankings. 7 of the 10 top-performing ETFs focus specifically on European banks, with the top 4 positions all occupied by banking sector funds. This represents a dramatic shift from conventional wisdom about ETF performance, which typically emphasizes U.S. technology stocks and broad market indices. The European banking sector's remarkable performance was driven by a perfect confluence of factors that created an ideal operating environment for financial institutions. The European Central Bank's shift from negative to positive interest rates was perhaps the most significant catalyst, as it allowed banks to expand net interest margins for the first time in years. 2 of the top 10 ETFs employ 2x daily leverage, demonstrating how leveraged products can amplify returns in sustained bull markets. However, these products also carry significantly higher risk and are generally unsuitable for long-term buy-and-hold strategies due to volatility decay and daily rebalancing effects. Contrary to the original document's emphasis on U.S. market dominance, our updated analysis reveals that European markets, particularly in the banking and leverage sectors, were the true outperformers during this period. This highlights the importance of geographic diversification and the dangers of home country bias in investment decisions. The top-performing ETFs were highly concentrated in specific sectors, banking, or employed leverage to amplify returns. Traditional broad market ETFs, which are often recommended for their diversification benefits, did not appear in the top 10 rankings for this specific period. While the returns in this analysis are remarkable, investors must understand the significant risks associated with these top-performing ETFs. Sector concentration risk. 7 of the top 10 ETFs focus specifically on the banking sector, which means they lack diversification across industries. Banking stocks are cyclical and can experience severe downturns during economic recessions or financial crises. Geographic concentration risk. The dominance of European ETFs in our rankings reflects specific regional factors that may not persist. Currency fluctuations, regulatory changes, and economic conditions can significantly impact returns for investors outside the Eurozone. Leverage risk. The leveraged ETFs in our top 10 carry substantially higher risk than unleveraged alternatives. These products can experience severe losses during market downturns and are subject to volatility decay over time. Past performance warning. The exceptional returns documented here occurred during a specific 5-year period characterized by unique economic conditions. These returns should not be expected to continue, and past performance does not guarantee future results. Liquidity considerations. Some of the top-performing ETFs have relatively small asset bases, which could impact liquidity during periods of market stress. The findings of this analysis offer several important lessons for investors. Sector rotation opportunities. The dominance of European banking ETFs demonstrates the potential rewards of successful sector rotation strategies. However, timing such rotations is extremely difficult and requires deep understanding of macroeconomic factors. The importance of interest rate cycles. The banking sector's outperformance was largely driven by rising interest rates. Investors should consider how different sectors perform across various interest rate environments. Geographic diversification. The strong performance of European ETFs during a period when U.S. markets also performed well highlights the benefits of global diversification. Risk-adjusted returns. While the absolute returns of these ETFs are impressive, investors should also consider risk-adjusted metrics such as Sharpe ratios and maximum drawdowns when evaluating performance. As we move beyond the 2020 to 2025 period analyzed in this video, several factors will likely influence the future performance of these top-performing ETFs. Interest rate environment. The European Central Bank's future monetary policy decisions will significantly impact banking sector profitability. If rates remain elevated, banks may continue to benefit from wide net interest margins. However, if economic conditions deteriorate and rates are cut, banking sector performance could suffer. Economic growth. The sustainability of European banking sector outperformance depends largely on continued economic growth across the region. Recession or economic slowdown could lead to increased loan losses and reduced lending activity. Regulatory environment. Changes in banking regulations, capital requirements, or tax policies could impact sector performance. Competition and disruption. The banking sector faces ongoing challenges from fintech companies, digital currencies, and changing consumer preferences that could affect long-term profitability. This comprehensive analysis reveals a dramatically different picture of ETF performance from 2020 to 2025 than was presented in the original document. The actual top performers delivered returns that far exceeded initial estimates, with the leading ETF achieving a remarkable 379% return over 5 years. The dominance of European banking sector ETFs in our rankings represents one of the most significant sector rotation stories in recent investment history. These funds benefited from a perfect storm of favorable conditions: rising interest rates, economic recovery, improved credit quality, and operational efficiency improvements. However, investors must approach these findings with appropriate caution. The exceptional performance documented here occurred during a specific period characterized by unique economic conditions. The high concentration in banking sector ETFs and European markets represents significant risk that may not be appropriate for all investors. For those considering investment in similar ETFs going forward, careful consideration of risk tolerance, investment timeline, and portfolio diversification is essential. While the returns documented here are impressive, they came with substantial sector and geographic concentration risks that could lead to significant losses if conditions change. The key lesson from this analysis is not necessarily to chase the previous period's winners, but rather to understand the factors that drove their success and consider how those factors might evolve in the future. Successful investing requires looking forward, not backward, while learning from the patterns and trends revealed by historical performance data.